The stock price has almost doubled in the last 6 months. In February, it was trading at around 50 rupees and recently it has touched 100. This does not look like a hollow rally. For the first time, Zomato has posted positive net profits. The food delivery business is performing better than the expectations of many professional analysts and fund managers. But there is one thing that could create problems for the company in the future. In this video, I will be sharing with you the recent developments in Zomato's business, and hopefully that will help potential investors have a better understanding of the company. Be sure to subscribe so that you don't miss future videos on investing and fundamental analysis. Namaste and welcome to Retail Investing. According to the company, Zomato is a technology platform. People use this platform to discover restaurants, order food, and get it delivered to their homes very fast. The food delivery division is taken care of by independent delivery partners who onboard themselves on Zomato. In financial year 2023, 64 crore orders were delivered through the Zomato platform. Zomato also has a quick commerce division known as Blinkit. Blinkit was formerly known as Grofers. Zomato acquired Blinkit for roughly 4,600 crore rupees and it is in the business of delivering groceries and essentials online. Zomato has an initiative named HyperPure under which Blinkit provides supplies to restaurants. That's a B2B business. This entire quick commerce business of Blinkit is still largely loss-making. Zomato's market capitalization is 81,502 crore rupees. It's trading at 99 rupees and within the last 12 months, it has touched a high of 103 and a low of 44. The face value is 1, so I would not expect stock splits. The return on capital employed and the return on equity are both in negative territory. That's obvious because the company did not have earnings in the past. It has a debt of 507 crore rupees and has huge reserves of 18,623 crore rupees. And its debt to equity ratio is very good at 0.03. Both the quick and current ratios are above 4. Usually, quick and current ratios above 1 suggest that liquidity levels are in the safe zone. But very high quick and current ratios could also mean that the company is not putting its assets to use efficiently to generate profits. However, that is probably not the case with Zomato. The free cash flows from the last 3 years are largely negative. Here is the income statement. As you can see, the company's sales were 466 crore rupees in 2018 and now it's 8,082 crore rupees. That's a 17-fold growth in sales at a CAGR of around 68% in the last 5.5 years. Even after achieving this impressive growth in sales, the company did not generate profits. If you look at the earnings per share numbers of the last 5 years, you will see that the per share loss was more than 70,000 rupees in 2020, which reduced to 23,000 rupees loss per share in 2021, and by 2022, the per share loss was only 1.5 rupees. And in the latest quarterly results, they reported a small profit. That is definitely a praiseworthy achievement by Zomato. When it comes to shareholding pattern, you can see there is no such thing as promoter holdings. In fact, Zomato became the first tech company to become an unicorn without any promoters. It falls under the category of professionally managed companies, and these professional managers largely comprise various foreign institutional investors. Among the investors, there is an international private equity firm known as Tiger Global. They first invested in Zomato long before the company was listed on the stock exchange, and recently Tiger Global has sold all the shares of Zomato it owned. It's probably not a worrying sign because Tiger Global has been selling a lot of shares of other Indian companies like Flipkart as well. It could just be their profit booking strategy in India. The CEO of Zomato, Mr. Deepinder Goyal, holds roughly 4.5% stake in the company. Domestic institutions own 10% of Zomato. Among the domestic institutional investors, 2 big mutual funds that I follow have recently invested. Motilal Oswal FlexiCap Fund and Mirae Asset Emerging Blue Chip Fund. Both these mutual funds are managed by very experienced investors and I would not doubt their stock picking skills. But that does not mean just copying them would guarantee good returns for retail investors. That's because retail investors may not understand their strategy and the reason behind their investing. Hence, we cannot predict for how long they plan to stay invested. If we get an idea how these institutional investors analyze the stocks, maybe then we can benefit. Public shareholding is 33.56% and the 2.09% shares owned by the others are actually ESOP, that is Employee Stock Ownership Plan. The first quarter earnings report was nothing short of spectacular, mainly for the food delivery business, which is the core business of Zomato. The food delivery division posted operating profits of 181 crore rupees in the quarter, but Blinkit and the B2B business of Hyperpure made heavy losses. Blinkit made losses of 133 crore rupees and Hyperpure's operating losses were 35 crore rupees. That's a total of 168 crores in losses. This looks like a typical case of what Peter Lynch calls diversification in his bestseller book One Upon Wall Street. Some companies which grow pretty well cannot digest their own success. They seek out acquiring other companies to diversify into other sectors. These acquired companies are often in terrible losses and are much worse businesses. Hence, Peter Lynch calls this attempt at diversification as divorcification. Now, this is the big problem with Zomato. Zomato decided to become a savior and acquire Blinkit. Shareholders would be so happy if the money was spent on paying out dividends and doing share buybacks instead of acquiring loss-making businesses. These unpredictable moves by management of companies are really troublesome for retail investors. For example, previously I was bullish on Nykaa. Nykaa's main strength is its online beauty and personal care business. Their plan was to leverage the internet infrastructure and acquire customers from every corner of the country. And now suddenly, Nykaa is interested in opening more and more physical stores. This totally changes the original proposition. It's a complete U-turn. So this is a big risk of investing even in fundamentally strong companies. Unpredictable moves by the management. When it comes to strengths, Zomato has massively reduced its per share losses in the last 2 years and brought it down to zero. They achieved it by cutting down costs. The operational efficiency has surprised many veteran analysts on Dalal Street. Secondly, low debt on the company's balance sheet is going to be a big advantage in the future. When the company reaches a break-even point, operating leverage will come into play. That's a situation in which every percentage increase in sales results in a higher percentage increase in operating profits. If debt is high, a few bad quarters of sales could reverse the operating leverage situation, which means a percentage drop in sales could result in a higher percentage drop in overall profits. I hope that did not confuse you. A separate video would be required to explain the concept properly. In the total revenues of Zomato, the contribution of the loss-making divisions of Blinkit and Hyperpure are going up. If these divisions don't turn profitable, they could eat away all the profits of Zomato. Secondly, Blinkit and Hyperpure require capital expenditures in the near future, which basically means a lot of expenses. It is a very simple concept to understand that investors benefit from earnings, not from expenses. And it's quite difficult to predict when these expenses will translate into earnings. One reason why the company was successful in reporting positive net profits was deferred tax payments. Deferred tax means the company owes the tax amount, but it is due for payment at a later date. All these things suggest a lot of expenses in the future, while earnings growth is likely to slow down due to the loss-making divisions. But these things may not stop the rally in the stock, and I will tell you why very soon. The biggest opportunity for Zomato is the massive growth in the internet infrastructure. All these new age companies like Nykaa, Policybazaar, Paytm and Zomato were created with the vision to leverage the boom in internet usage. It's a very cost-effective way of acquiring customers across the length and breadth of the country. The second big opportunity is the fast growth in per capita income. With higher disposable incomes, people will happily spend more money on each order. It has been noticed that food delivery businesses cannot become profitable if the price of each order is too low. And the third opportunity, in my opinion, is the growth of electric two-wheelers and ethanol-based two-wheelers. The widespread use of these delivery systems will definitely have a positive effect on operational costs. The only threat that I can think of is competition. If you can think of more threats, please type in the comment section. You see, on paper, there are not many competitors and the industry is a duopoly of Swiggy and Zomato. But in practice, there is fierce competition in the industry. There is a constant price war going on between Swiggy and Zomato. The concept of a superior brand may not be applicable here, and I cannot think of a business moat. There is some possibility that the current rally might continue with some consolidations here and there. A big section of the investing community is heavily bullish on this stock, and I am talking about big investors. So I would not be surprised by more upside. However, when it comes to my personal investing decisions, I never let fear of missing out a rally make my investing decisions for me. As a retail investor, I would like to play safe and wait until all the business divisions turn profitable. Had Zomato not diversified and acquired Blinkit, it would be an easy buy decision for me. But for now, Zomato goes to my watch list and I will track its financials for the next few quarters. Now this video was not a buy, sell or don't buy recommendation of any kind. It was only for educational purposes. And please don't forget to type in the comment section what are your views on Zomato. Thank you very much for watching this video and I'll see you soon. Jai Hind.